3 undervalued dividend stocks at their 52-week lows. We're going to take a look at each historical performance. As always, we'll look at their dividend safety, we'll jump into their financial metrics, and we'll run them into the valuation model to get to the intrinsic value, get to our acceptable buy price with our investor margin of safety, and look towards Wall Street to see what they're forecasting for the next 12 months. So let's kick things off with stock number 1. We have Archer Daniels ADM. Now this is down around 34% over the last year, with a lot of that being the recent accounting issue which we covered on the channel a couple of months ago. Over the last 10 years, however, they are up 32%. Bear in mind this doesn't include those dividends reinvested, and we can see they've hit their all-time highs of just under $100 a few times over the last few years. Currently right there at their 52-week low, they do have a nice yield just under 4%. They did recently increase that dividend, and we can see a forward P of just under 8. In terms of dividend safety, it's sitting at 80. We can see the market cap as well, 29 billion, a large cap company. In terms of those recessionary metrics, for those that see a recession inbound, well, they increased the dividend during the 07-09 crash. They had below average growth, negative 21% versus the S&P's negative 12%, but they significantly outperformed with a negative 21% recession return, whilst we see the S&P coming in with a negative 55%. Dividend growth, as I mentioned, they increased it double digits this year, January 11%, although the last 5 years was a little bit lower at 5%, but we do see over the last 20 years they have been increasing those dividends on average by 11%. We also note they are 3 years away from becoming a dividend king. Currently they are a dividend aristocrat, as they have increased those dividends for 25 years or more, and we also see they have been paying a dividend for 92 years without a reduction. Now, in terms of dividend yield theory, for those that are new, typically states a company is undervalued when the current yield sits above the 5-year average, 3.72 versus 2.48, so that's our first sign of undervaluation. Bear in mind we're not looking at any of these models in isolation. Another severe sign of undervaluation on the forward P, 9.3 versus that 5-year average of 13.7, and we can see it is much lower than the consumer staples sector P of 20. As always, free cash flow payout over the earnings. Earnings is susceptible to manipulation by management through accounting. Personally, I like to see below 60%, although for consumer staples, if you want to be industry specific, you can look at 70%. Below 60, in my opinion, means that management are able to offer those double-digit increases we love to see. Now, 2022, it came in at 42%, so fairly positive. 2023, now a bit of a red flag indicator, and one of the reasons why I do focus on the free cash flow, 196%, signaling that management in 2023 paid out more in dividends than they generated in free cash flow, something you wouldn't have been able to pick up if you looked at the earnings coming at 23%. Now, in more positive news, we do know, however, this is expected to come all the way down back to 46% in 2024, which makes it a lot more attractive. Free cash flow per share, well, what we can see here with ADM, there was a number of years, in fact 2016 to 2020, where they were returning negative free cash flow, although we note it did rebound nicely in 2021, although 2022 and 2023 have both subsequently gone lower. Again, 2024 expected to be a much better year, 438 to the free cash flow. Sales growth, again, we do notice periods of inconsistency. In fact, 2013 to 2017 of negative growth, although we can see the last 2 full years strong double-digit growth. But be aware that 2023, when they release their annual report, they are expecting a 2% drop. So numerically speaking, it goes from around 90 billion in 2013, coming down to around 61 before seeing 102 in that latest annual report. They do, however, return excess cash to investor pockets by doing share buybacks, 663 million shares, and now it is around 548. So they are returning those excess cash, and we can see it is a very positive sign. In terms of share buybacks, if you want to see other companies that do a lot of share buybacks, giving a lot of excess cash to investor pockets, that is one of our latest free weekly newsletter articles, amongst others that we have completely accessible for free. Do click on that pinned comment below. Taking a look now then at their return on invested capital, what I like to see at least 10% or more. That gives me faith that management are able to effectively allocate their capital. And what we can see, the last 2 years looking nice above 10%, although we do see for the large portion of the 10 years it has been below that, so one metric to keep an eye on. Operating margin very low for a long period of time. The only positive to note here is that from 2019 at 2%, which was extremely low, they have managed to increase that to 4%. I would like to see some efficiencies over the next few years, bringing that much closer to the 16% we want to see for the consumer staples industry. Free cash flow margin as well, we are looking for 7% as a minimum. We can see them struggling year on year, although we do note 2021 was fairly positive, but unfortunately the next 2 years we can see it has lowered down. So again, a few metrics for ADM that I would keep an eye on if I was an investor or even potential investor. Net debt to EBITDA, earnings before interest, tax, depreciation, amortization, shows us balance sheet strength, dividend safety. So 1.29 in 2022, this is the number of years it would take them to pay off all of their debt net of cash on hand. Nice to note 2023 is lower at 1.18, but what I would say, it is expecting to go back up in 2024. Overall though, we can see it is well below that 4, so the dividend does look to be safe and the balance sheet does look to be fairly solid. So let's jump into the valuation of ADM, and as always, if you enjoy the content, values being provided, smash that like button, hit that subscribe and bell button so you are continually notified of these videos as they drop. Typically on the channel, we do run through every single one of these models. Let's get straight into the intrinsic calculator today, and it is the average of these 4 models. So for today's episode of ADM, we have an intrinsic value of $67 with the current value around the $54 mark. We start off with 10% margin of safety, and we use this if we believe it has a wide moat, strong financial metrics and good forward-looking data. So we keep going to this near the current trading price, and at 20% it is pretty much bang on that value. So based on our estimates and judgments, we have a margin of safety for ADM of 20%. In terms of Wall Street and their forecast, well, they see a price target of $66 over the next 12 months with upside of 23%, making them see ADM as a very strong buy. Don't forget, as we do go through, do drop your thoughts in the comments below as to any of these you have been picking up over the last few weeks. The next stock that we are taking a look at is Gilead Sciences, GILD. Now this is down 11% over the last year. Over the last 10 years it is down 11%, and we can see its all-time highs quite some time ago at $120. Now trading pretty much at their 52-week low with a nice starting yield of 4.2% and a forward PE of 10.4. Dividend safety score sits at 70. It is safe. Market cap at $91 billion, a large cap company. In terms of their key recessionary metrics, while they didn't pay a dividend, so no comparative data, they had plus 13% growth, so this is above the average growth versus the negative 12, but an extremely impressive recession return of 4% when the S&P returned negative 55, one of the best recession returns companies we have analysed on the channel alongside Walmart that we did review earlier today. In terms of dividend growth, well, not the greatest this month. In fact, they did announce a 2.7% increase. As always, we want to see a minimum of 4% on the channel. The reason for this is because the US inflation rate over the last 40 years was 4%. Anything less, you are taking a pay cut and losing purchasing power, whether that's your dividends, salary, or other income producing assets. Nice to note though, over the last 5 years, that 6% level looking a lot more attractive. They have also been increasing those dividends for the last 8 years consecutively. Dividend yield theory, then we have that sign of undervaluation, 4.19 versus 3.96, although we do note the forward P isn't too far off that 5-year average of 10.1, although we do note it is much lower than the healthcare sector P of 17.5. In terms of their payout, well, below 50% for biotechs, as we can see here, and it has in fact been below that consistently. 47 in the latest year, 2023. 2024 expected to go even lower, so that payout ratio is looking very healthy. Free cash flow per share, well, $8 in 2014, and in fact it has been decreasing, not what we want to see from any company on the free cash flow per share. The positive to take from here, however, is that in 2023, the $6.42 is expected to be increased in 2024 to $7.50. In terms of sales growth, well, we can see very inconsistent. Some years positive, double-digit, even triple-digit growth in 2014. In the more recent period, negative 1%, 0% in 2022. So the top line has remained relatively flat. And we can see it has gone from around $25 billion in 2014 to $27 billion in 2023. In terms of returning excess cash, well, we do see them doing share buybacks, 1.65 to 1.26, but it's worth noting they haven't bought back any shares since 2020. So let's take a look at the ROIC. Very, very positive in my opinion. It is very strong, 19% in the recent year of 2023. Yes, we can see previous years where it's much higher, but as long as it doesn't go below this 19 to 20% level, then it does look to be fairly strong in terms of this metric. We do see both margins declining, however, both of them still looking very strong and healthy. 2023 is 36% on the operating margin, above the minimum, and the same to be said for the free cash flow margin. So whilst it may be something you want to keep an eye on, given it has decreased, nonetheless, in the standalone year, still looking very, very strong. Net debt to EBITDA 1.57, biotechs we want 1.5 as a maximum, so a little bit over, but nice to note 2024 is expected to decrease, hence why we do see that safe dividend score, and the balance sheet therefore, on as a general overview, does look to be healthy. In terms of the valuation then, getting to the intrinsic value of Guild, and as always, if you do want to grab a copy of the valuation model to get to the intrinsic value as well as the acceptable buy price of companies in your own portfolio or watch list, you can click on that pinned comment below. 10% margin of safety, a buy up to 88, 15% up to 83, and at 20% we can see here that it is a buy still, and then we go to 25% where it is pretty much a few cents shy of the current trading price, so we see a massive 25% margin of safety. In terms of Wall Street, well, they also see some strong upside of 17% with their price target of $86 over the next 12 months. Stock number 3 is Hormel Foods Corporation. Now this is down 33% over the last year. Over the last 10 years, however, up 29%. And we can see their all-time high sitting around that $52, $53 mark in 2022. In terms of a forward yield, again looking very nice, just below 4%. Although we do note their forward PE sitting around 20 as well. In terms of the dividend safety, well, we have a very safe score, a market cap of just under 17 billion, another large cap company. So let's take a look at those key metrics. While they increased the dividend during the last recession, they had above average growth at -4% and also a very, very strong return, -15 versus the S&P's -55. Again, not the greatest increase, below inflation in November last year. However, they do have a strong track record with the last 20 years on average increasing those dividends by 12%. They are also a dividend king. They've increased those dividends consecutively for more than 50 years. In terms of dividend yield theory, we have a double sign of severe undervaluation on the yield front, 3.7 versus 2.11, and on the forward P, 19.7 versus 24.4. And when we look at that, it is pretty much near enough in line with the consumer staples sector P of 20. So in terms of the payout ratio, what we have here is free cash flow 70% as a maximum for consumer staples. And since 2019, it has been pretty much straddling around that level. 77 in 2023, although in more positive news, 70% expected in 2024. Free cash flow, it has increased from 111 to 142, but we do see a ton of inconsistencies every single year. 2024, although it is expected to increase to 162, it is worth noting and very important to understand the type of companies you're investing in, just to acknowledge the type of returns you are expecting, especially when looking at these metrics. 3 to 7% is what we always want to see at a baseline for sales growth for the majority of mature companies. We do know this is very inconsistent. They go through periods of increasing to the top line followed by negative, and we can see 2023 followed that trend with a -3% from a 9% up year. So numerically, we do see their top line go from 9.3 billion to 12.1. Shares outstanding, well, they've diluted your position over the last 10 years, as we can see, going from 540 million to 549, although not the greatest increase, but still worth noting. ROIC, whilst I can be happy with the 9% in 2023, important to understand the trend is declining. So again, moving forwards, just something to take into account when looking at your investment thesis, as well as anticipating your level of margin of safety. Operating margin, 15% over for consumer staples. What we can see here is, again, not only has it been declining since 2016, but also below that level. Not necessarily a bad thing, but just something that you do need to keep an eye on, as you don't want it to continue to decrease. And in fact, it would be nice to see the trend reverse to an upward style. Free cash flow margin pretty much straddling around the 7%, so no worries or anything to note here, although we can see 2023's 1 percentage point below the anticipated and expected figure. Net debt to EBITDA, pretty positive in my opinion, 1.36 in 2023, expected pretty much bang on in 2024, well below the 4, so we can see why that dividend does look to be very secure, and their balance sheet does look to be healthy for now. In terms of the valuation then, let's jump in and get to our intrinsic value, and we can see for today's episode, Hormel Foods is coming to $34. Current price at $30.44, we start off with our 10% margin of safety, and we get to pretty much a few cents shy of the current trading price. So we see a 10% margin of safety, with Wall Street over the next 12 months seeing around a 10% upside with a price target of $34. As always, let me know your thoughts in the comments below, whether or not you're looking to add ADM, GILD, or even HRL, all looking fairly undervalued at their 52-week lows, but there are always risks associated with these companies, something just to consider. And if you do like any of these and want us to do a deeper dive into, as we typically do, then do drop us a comment below. As always, if you enjoyed today's episode, smash that like button, hit that subscribe and bell button so you are continually notified of these videos as they drop. And for now, catch you on the next one.